All right. Well, greetings, everyone. This is very kind of, I think, timely. We're waiting anxiously, those in the kind of macro space, to find out who Trump will appoint as Treasury Secretary. And it's kind of important. Yellen obviously leaves in January. And anyway, today's they're announcing who it is. So I've been very, very, very focused on that. Why does it matter? The Trump trade, and by the way, none of this is political. This has to do with what's the market direction, what's the sector rotation, the stock selection related to the policies that are absolutely going to drive and have driven so far, little start here, prices. So I am very much focused on policies that dictate price. And my name is Samantha LaDuc. So for those who may not know, my name is Samantha LaDuc. I'm the founder of LaDucTrading.com. And I actually run a financial research firm as well as trade support, trade alert, all that good jazz. I run a live trading room, but I also have a team of 10 subject matter experts. And this is basically all we do all day long is focus on what is going on in the market, big picture, right down to trading, futures and day trading. So I have basically a team that specializes. So those of us who are more macro are Jeffrey and myself. He's my economics advisor and specializes very much in this monetary and fiscal world. And also as it relates to rest of world, Hans has specialized in running funds using options. I'm a professional options trader, so that's very important to me in helping clients, whether retail or institutional, utilize options as well for alpha as well as hedging their portfolio risk. But I have really across the board subject matter experts from oil trader to biopharma analyst, advanced options, Elliott trade, an analyst, gamma, you name it. So I'm very, very excited that I can kind of bring this, synthesize this for you today, which is what are we looking at? And what have I been sizing up in this market given the run into the Trump election? And then what does it mean moving forward? Because right now we're in the throes of his cabinet, and there are some interruptions also in those cabinet appointments, and some have not been announced yet, like the Treasury Secretary. And then there are others that need to be approved, like Robert Kennedy, but they all have very, very big impact on market direction, sector rotation, and stock selection, which is where I focus. Then using options as an overlay technique on how to manifest those trades and define risk. Speaking of those who might be interested in this whole kind of options arena, since this is very, very much, I know, kind of a macro to micro theme that I'm discussing and the trades that support it. If you are not familiar with options, I want to invite you to check out our 3-part option video series, which is from our master options trader and educator, Hans Albrecht. We also run a Wednesday, it's called Macro to Micro Options Power Hour, where we size up, for example, not just market direction, but also earnings trades. So we have had fabulous success in Tesla and NVIDIA, and even yesterday I expect it to be a premium seller's dream, and it was. So the point is, we will talk options. It doesn't always have to be advanced options, but that's definitely the goal, is to help elevate for those who are stock traders, ETFs and indices, to elevate and learn options, then to apply it in your trading. Again, whether it is directional, whether it is income, whether it is protection. So definitely check this out. It's a free 3-part series. And I will let you know that I do have this little presentation over here on the side. Hopefully you can follow this big white area here, but this is my Slack workspace, and I was putting together some thoughts about this Trump trade, which is really, that macro to micro focus that I do in all respects. And as I just kind of mentioned, policies dictate price, but we don't really know what they're going to be. We got 59 days before inauguration. And predictions are hard. right? Especially about the future. So what I'm predicting is not always, right, going to be down the road played out. I am trying to, however, predict, because that's my job. I was very successful in calling this little, what to expect here on election. So 30 days before the election, October 7th, I made my bet that Trump would be elected. And again, it is not my political yearning here to push an agenda or to choose a candidate because of some preference that I have. It simply was, I have a good track record of predicting. So I did this, and I do this for clients, by the way, in advance. So it's all documented. But in 2016, I predicted Trump would win, and I called it the Bubba factor. And for those of you who don't know me, I grew up on a farm. Anyway, in 2020, I predicted that Biden would win because Trump mismanaged the COVID crisis and some other things. Basically, that drawdown we navigated just with precision, that 35% drawdown from February until March. So this is something I also came out, believe it or not, in December of 2023, when I did my year-end predictions, I should say my year-ahead predictions for clients. In other words, in December 2023, I made my 2024 predictions. And I had 5 top predictions and then a bonus. And the bonus literally said Biden would not be on the 2024 ballot. So I like this game. Then in February of 2024, I predicted RFK Jr., Robert Kennedy Jr., will trend and surprise. I did not predict that he would drop out, let alone back Trump. Now, it's very, very hard to make a call, but literally I did. Trump will win. And that's basically why I did it 30 days in advance, was to set up, okay, so how is this going to affect the market, macro, and all that jazz? And let's go back first for when I did a write-up for clients and then made this available, actually, because it was a really good, I thought exercise, where I back in literally what to expect if Trump wins the 2024 election in January. Okay, many, many, many moons ago. And my whole point was to look at the effect of inflation, since that was one area before we knew about DOGE and this government of operational efficiency and all of that. Before anything was known about RFK joining, and we had no idea. My point was to kind of highlight some of the policies that would be affected, and one of the biggest controversial ones is immigration. So my point was simply to call out, not an agenda, that this was kind of important, that we had very clear immigration, right, under Biden, which was lots of folks in here to take up the labor slack, which helped pull down that inflation that was generated from both Biden and Trump spending a lot from the COVID lockdown, right? So we're talking QE, 9 trillion, monetary easing, plus the stimulus, all that fiscal spending. In the meantime, the immigration is now going to be reversed. And my point was, yes, this is going to be inflationary, but we didn't have all the consideration that we do now as far as some of the changes that could be underway as it relates to fiscal restructuring, which is a big deal. So I want to kind of just put that as a placeholder, just because Biden let everybody in and it took up the slack in the labor force, which helped keep wages from spiraling higher. Now that we have deportation of illegal immigrants going out, does not mean wages are going to spiral higher. So I want to just kind of put that out there for a little bit, because I think we have something else that is a little bit bigger theme. Let me go back to this, okay? Which is the dollar very much is going to make the weather. So let's kind of, I'm going to skip ahead here. I'll go to the map, to the map in just a little bit. So when I did this January call, right, that was basically, what if Trump wins? We're going to kind of start thinking about it. And then 30 days before the election, I said, okay, now we really got to think about it. I wasn't expecting RFK to join, and Vivek and Tulsi Gabbard and all of these independents and libertarians and Democrats, converting and coming in to sweep the election for Trump. It was absolutely a joint team effort. But one thing that I have changed very strongly is when I did this 2020, this January write-up, I said, okay, so we can have some immigration hit on labor and, potentially cause the wages to go up. But we're going to have another issue, which is Department of Government Efficiency, DOGE, is going to come in and apparently recommend a lot of cuts, right? So that's a deflationary event. Also, oil rolling over. I did not see that in January 2024. I came out in April. This is on a monthly chart of crude, and I've shown this here before. I still see crude rolling over. So I'm not talking about you get a spike because of Middle East conflict, but I'm talking about the demand for oil because of lots of substitutes, EV and solar, and just de-dollarization over in China. The whole point is the petrodollar and the lack of demand. It is causing this to fall. And so this is actually going to be potentially an economic stimulus for us. And that's not what's usual. Usually we see oil go up with yields or go down with yields. And that right now they're doing the opposite. They're going down and yields are still staying firm. So I think that's going to continue. So that is the one big difference for those who might have read that article back in January. And there's another really big difference. I think the biggest difference is this. And this is what will drive equities. I'll make this even bigger. How do I make that huge? So I actually think that one of the biggest kind of under the radar macro Trump trades that there possibly could be is the agenda that is sizing up right now to devalue the dollar to make up for high tariffs. Now, I know everyone has their opinions of whether this is really just a negotiating tactic to get 60% tariffs on China, if it's, retaliatory. No, I really actually think they're going to be negotiated as well, probably lower. And they're for the purpose of having this reciprocity, right? Why do Europe and China and other countries charge us tariffs and we don't charge them tariffs kind of thing, right? So we're going to be reversing that. And that's actually very helpful for helping the other countries demand less dollar. So this is going to, the demand for Dixie is basically what is going to cause that weakness. And I think that that's what folks are maybe not seeing right now. It doesn't really mean that we're going to have this happen all at once. It's a huge, we have $7 trillion transacted every day, that the dollar's not going to lose its world reserve currency. It's very good for countries to actually exchange with each other. It'll help us build up a trade surplus. These are all good things. I'm not so freaked out about it like some. So my point is, though, I think this is the number one thing to look out for, that in order to justify some of these high tariffs, that there will be an effort by the Trump administration to devalue the dollar, and it will be stealth and you won't feel it so much. But the point is, the idea is that by lowering demand for dollars, which by the way is overvalued relative to foreign currency, it will make it much better for US exporters and not importers. So bring up your list of the US companies that export a lot abroad, and that currency conversion in dollars is either a headwind or a tailwind on their profitability. It's a big factor. So this will help US companies, obviously, as the dollar weakens relative to importers. So those in China, for example, who are trying to get their products here, it won't just be made more expensive. It will, and also incentivize for them to come in and do more manufacturing here. That's not really the end. I think the end goal is to get this industrial renaissance. And this is really why the cabinet appointments right now are so important. It's bring manufacturing and jobs back to the US. Now, that sounds all great, but it's the devils are in the details. And one way that this is very stealth is to devalue the dollar makes assets look better. So we're kind of in that right now. So we have had a very large kind of overvalued status relative to FX. And there are some things that are happening, I think, that are, I'm going to show you, hold on, that are showing themselves. For example, if the Trump macro trade is devalue the dollar to make up for high tariffs, for example, lower demand for Dixie, then to help US exporters, not importers, then this is the kind of stuff that we're going to see more and more, I believe. This is going to be how countries respond to US tariffs, and another way to remove demand for the US dollar is that these countries will offset most of their lost trade with the US simply by trading more with each other. So that's one thing. So keep that in mind. They're going to trade more with each other, and that's fine. It's also fine, honestly, that we have this recalibration, I believe anyway. There was a great interview by Stephen Mirren, who talks about how, persistently overvalued dollar, which I believe is really the target of Trump's tariffs, is going to, literally break down in the nitty gritty of how the trade and current account balances, et cetera, push the dollar up, the demand for US treasuries, all of that stuff. It keeps everything overvalued while the currencies are artificially suppressed, and why tariffs can be used to restructure the whole global trading world, which folks are getting freaked out about because they think it's linear. In other words, higher tariffs, we have to pay more. But as the dollar's devaluing, you'll feel it less. Anyway, that's to be determined. The devil's in the detail how they're going to pull this off. But the point is, there are measures that they can absolutely take to lower demand for dollars. Okay, I'm not talking about a shortage of dollars and the milkshake. No. I'm talking about lowering demand of the dollars, because that they're not just going to, for example, in the case of the dollar yuan, which is the renminbi, they offset Trump's tariffs when he was president, POTUS 45. They literally, they had 20% tariffs and they devalued 17% so that they couldn't feel it so much. It was not so burdensome, right, for their own consumers. But guess what? 60% tariffs, they're not going to be able to devalue that much. So I think what happens to the bond market as US assets are sold by foreign holders is going to be very important. So right now, this is the biggest thing that we're trying to figure out. So those who are trying to solve this puzzle, and we can't because we don't have he's not in power making policies. He doesn't even have a full cabinet yet. But the point is, the 17% of the US equities market, I'm not even talking real estate or bonds, treasuries, I'm talking US equities, 17% are owned by foreigners. So as they start to lose value in those assets by a falling dollar, they will also repatriate that money and go home. So there is some risk to the stock market getting a hit, but stateside, what I'm trying to kind of get at is we have, yes, an immigration policy that could be inflationary to wages, but deregulations, AI, and weaker energy prices can be deflationary. They can help offset some of this impact from higher tariffs. So hopefully we don't have a situation, however, where the falling dollar will trigger even more animal spirits in equities. And I think that's what the market is right now front running, if that makes sense. They're front running the Trump presidency because of deregulation, because of pro-growth policies, and because also of an expected falling dollar. Now, there are other ways to deal with also getting, I should say, other countries to demand less of our US dollars. And right now it's happening in spades between China and Saudi Arabia. Okay, that's a detailed little post, but I'm just going to say they're exchanging things for paper, and they're doing it to bypass, in some cases, US sanctions, and in other cases, it's just the cost of conversion. So this is another way. I just saw this today. I literally just tweeted this today. The state of Texas just banned investment into Chinese companies and is forcing divestment of any state funds from Chinese companies. Now, some would have said they should have been done a long time ago. I'm not taking that position. I'm saying when the US makes policies like this to force foreign entities who have ownership in equities or real estate or companies to go home, it's another way to force lower demand of US dollars, which is my baseline bet for a Trump policy agenda. Does that hopefully makes a little sense. So they're going to devalue the dollar by lowering demand for Dixie, which, by the way, I would just mentioned is still really overvalued. And I think that's the focus I wanted to put out here for those who are macro minded and they might disagree, and that's perfectly fine because I'm working this out. At the same time, I'm running a trading room, writing up market thoughts, and trying to figure out if Trump has announced his Treasury Secretary, because rates really matter. And the direction of Treasury issuance really matters. And this is also something that really matters, reducing government debt through fiscal restructuring. By the way, if they could pull this off, it'll be very impactful. It could be, short-term pain in the equity market for long-term gain. It would also help stabilize US bond value, which has been falling for 3 years and has no reason to get back up if they keep spending like drunken sailors. So let's go talk about this DOGE, right? This Department of Government Efficiency, which sounds like a joke set up by Elon Musk and Vivek, last name I'm not going to try and pronounce. But the point is, I want to talk about this because if they pull this off, I want to show you what it actually could mean, okay? So this is DOGE right here. DOGE is $2 trillion, apparently, is what Musk was hinting at as far as a potential way to, cut lots and lots of government inefficiency, right? Because we have an exploding debt profile, which is very dangerous for forced devaluation of dollar, which we don't want, and also for falling collateral values in treasuries. So this is something where I kind of looked at this. I saw a video where he was explaining, it was a recent speech, that there are 3 nanny states that represent government bloat that need to be shut down to solve our national debt problem. And I started looking at this going, this is kind of interesting. Let me look at this. Now, whether they can pull this off is another matter, and you can make your own bets on this. I'm trying to weave this in because if I believe, and I do, that this whole, making U.S. Exporters the power, giving them the power position, it has to go hand in hand with reducing government debt through fiscal restructuring, and all with the goal of bringing back an industrial renaissance. Now, this is if then, right? But let's just kind of jump ahead here. So these are the 3 nanny states that Vivek talks about. Entitlement state. That's where you've got welfare, Medicare, any type of government assistance program. He's saying attach work to it. Just stop, spending without any parameters or guidelines, but definitely there is a lot of waste, especially in Medicare. It doesn't mean, send grandma out into the cold, but the point is there are a lot smarter ways to deal with entitlement that have not been touched because politically it'd be suicide. And by the way, Vivek and Musk are not elected or not appointed. They're consultants. Trump can ignore everything they say, or he can say, good job. Now, the second area he talks about is regulatory. One thing that we kind of assume, but it's a very hot subject, is that there are many bureaucrats that are basically what I call chair warming. Vivek just says, these are 4 million bureaucrats who are unelected officials, get rid of them. And they also are making the point, both of them, that 75% of regulations are unconstitutional. I didn't know that. But again, this is their basis from which they are working to cut the fat. So remove them. That's what Vivek said. And they do not want to have any budgeting whatsoever as a government expense like foreign aid. So this is going to be hotly contested. I know this. Politically, I feel for you if this is upsetting, but I'm just saying these are the 3 pillars or legs of the table upon which DOGE is setting out to cut in order to retain America's, vitality and future again. This is their spin. Now, what he doesn't discuss is how much bloat they can remove in dollar value, which is really interesting to me because Musk mentions 2 trillion in cuts, right? But I looked into this and I'm like, but wait a minute, you got mandatory spending, Social Security, Medicare. Now, granted, you can't get rid of Social Security, but Medicare, I mean, not now, but point is, there are some ways you can still improve it, right? But ultimately, there is just 1.7 trillion of discretionary spending, of which half is defense. Now, I don't know if you follow their channels on Twitter, but oh my God, they're tearing apart the Defense Department for failing its audit and all the fraud. And they're going to go for some of that 900 billion. There's no question. But it really just leaves realistically about 1 trillion to restructure. So let's assume this, okay? This is all under this point number 2 that I have, right? So first is they're going to, you know, have foreign demand of dollars fall, which helps weaken the dollar to help US exporters. Number 1. Number 2, fiscal restructuring. And this is the DOGE thing, right? And it's all that I have available, so this is why I'm trying to put it together. Here are some of the things we can really assume if this works. They're going to remove $1 trillion in government largesse, right? They got about $1 trillion that they can cut. They're going to remove war spending. You see, that's, I know, very contentious, but that's what they're saying they're going to do. That's what Trump is saying is going to do. Not so sure about his position on Israel, Iran. It sounds like they're very, very supportive still, but definitely not of Ukraine. So this is an area where they're looking to cut war spending. And this is also where they're absolutely targeting, remove the fraud from government budgets, specifically defense budget, remove a whole bunch of chair warmers, right? I mean, they're literally talking think about that, 4 million bureaucrats. Drive productivity, this is the positive that they're pitching, from this entitlement reform. In other words, think of this, if their thinking is, if you tie work requirements, right, to welfare, it's going to drive productivity. And if you remove these regulations, which are, they say, unconstitutional, it's going to stimulate organic growth from deregulation. So in this world, if they can pull it off, then I can imagine US bonds will actually be valued collateral again. So that would be very good if they could pull this off. What wouldn't be good are the companies that are right now delivering these government contracts, right, that has been filled with tons and tons of pork and or bloat. So I don't know if you looked recently, but some of these government contractors took a header after Trump's election. So while lots of companies were doing extremely well and happy on the Trump election, there were a few sector rotations that were very, very obvious. Defense contractors, GD and Raytheon and Lockheed Martin, they came down hard. The government contractors like SAIC, they came down hard. So you know what's working and you know what's not working. And this is just an idea of how this could continue based on what's happened most recently. What I haven't even talked about really is this MAHA. This is another one that is very hot under the collar, I know, but I'm going to bring it up anyway, because we had a situation where, this is the dollar, this is MAHA, where the MAHA trade was something that I put out there right when RFK was offered the job as Secretary of Health and Human Services. And again, policies dictate price, right? What's the trade? Well, wouldn't you know, he's got 2 trillion. Yep. So RFK Jr. basically, if Senate approved, and I know it's very acrimonious, but if Senate approved, then there are many, 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 many department agencies that he will have control over. And this is going to be actually quite an impressive hit. And we've already started to see it. Now, this is something that I've discussed already with clients for weeks now, which is stuff that's related to XLP, which is the defensive staples, right? The Coca-Colas of the world. XLV, lots of healthcare names in here, but mostly drug manufacturers. These are the biotech ETFs, for example. And these are shorts that we have been setting up in the live trading room, and they have been posted, whether it be Novartis, which is a European company in the weight loss space. These are just examples, right? Eli Lilly, really, really warned that this was going to come back down and get hit. It has broken. It's on its way to 650 from 950. Any of the big drug companies, they were already hit, and the hits keep coming. I'm very, very fortunate, as I mentioned, that I work with Dr. Alexander Kenton, and he runs our Kenton's Corner of Biopharma. He writes up deep dives into biotech and biopharma space. He shares all of his trades, healthcare, hospitals, biotech, you name it. He's so good. And we benefit from that tremendously. But one trade that he suggested a while back was Merck, and it continues to fall, even before all the Trump election. But the point is, these are still going to be under distribution. This is not a safe thing to buy. I know everyone's excited about lots of these pharma companies, but they're not safe to buy when in fact you have someone who wants to come in and disrupt these players, get them out of media. By the way, this is another area, media companies, right? He's already announced, and Trump has agreed that, no more pharma ads, and that will hurt some sales of these media companies. Comcast, who owns NBC and MSNBC, has already said, yeah, we're out. We're going to sell these companies off, and they're going to go try and manage themselves. Anyway, the point is, there are many plays also within food processing as a short. Unilever is very diversified. We've got, chicken and Kimberly-Clark and Campbell's Soup and General Mills. So Arthur Daniels had already broken down, so it's kind of tough. But I joke, it's kind of tough to short corn syrup. But with Kennedy pushing for sugar to be used instead of corn syrup, then you can find some plays that are agricultural based, right? It's very hard to short Monsanto, which was an immediate, thought by many clients, but they were already merged with Bayer over in Germany back in 2016, and they have been suffering since. So these are hard ones to play, and any and all changes that he's going to make are going to take some time to be realized. Some of these plays had already started to come down. This is Monster, Celsius, even Domino's Pizza. It didn't stop Berkshire Hathaway. It doesn't mean that all these stocks are going to be hit, but the point is, it means be more aware, right? So Berkshire, may not stay in this stock very long, but it loves big brands, and Domino's is a very well-known brand. But they also own Coca-Cola. Coca-Cola is not going to go belly up. It's just that they have maybe margins that they're going to be compressed because they're not going to be using corn syrup, which is cheap. They're going to have to use regular cane sugar. So that's a little bit more expensive. By the way, sugar producers of note are mostly in India and Brazil, and they're small regional players, and it's a little bit harder to play. I'll tell you one name that I am trend long and will stay trend long. It's called DBA, and that's further on. I'll show you that. Fluoride in the water. You've probably heard this, right? That's really tough to short honey. Let me just bring that HON is, let me just show you this. Honeywell International. Like, this is really tough to short when Elliott Management, right? This Elliott Management just came in and announced they're taking an activist role. So I'm not saying that these are going to be the best vehicles. We were already short XLV, XLP, Novo, Eli Lilly, Merck. They're working right now. They're taking a pause. He's got to still get, approved. But the point is that all of this space means it's a little bit harder to get excited about. Now, I am trend long, for example, TJ Maxx, BJ's. There are many who are trend long. Walmart and Costco, they're not going away. It might be some time to protect. But the point is, the biggest focus will be on industrialized agriculture, and that's kind of a tough play. The meat processing monopolies, right? It will have an effect on food prices eventually, but for right now, commodity prices, I don't think should be shorted. For example, DBA is that agriculture ETF. It's been a long time trend long. I think it's very well positioned to kind of take advantage for those who are not commodity traders per se. And then I know some are really getting into Kennedy being pro psychedelics and cannabis. That's not my wheelhouse, but these are some names that, they may they may move, but I'm not so excited about it. What I'm excited about is the macro. The macro is that he now has a $2 trillion budget. It's the single largest budget of any department in the entire government. Really, don't underestimate this trade. So, big picture, he's trying to turn around a true $2 trillion government organization, if approved, and it oversees a good chunk of US market cap. That's my point. And GDP. So we're not just talking, a few drug manufacturers. We're talking about the healthcare and food industry in general, and then biopharma and food processing in particular. This is not a day trade. It's something to keep in mind. But that's what I mean by, as part of the Trump trade, is really the MAHA trade. And part of the Trump trade is also this recalibration of the US dollar. So I've written about this. I've talked about this when I just kind of showed you examples of how the US government will probably create some ways to reduce demand by foreign entities for the dollar. But this recalibration is actually, again, good for US exporters, not importers. Notice you'll see kind of cars, so Toyota, German, BMW, Mercedes, they're going to have, more tariffs if they don't if they don't reciprocate with Trump. So likely Germany and Japan will reciprocate with Trump, but China, of course, has reason to worry, is basically it. So in this particular kind of focus, I'm getting really into some of the macro stuff, but there are micro considerations like the dollar. We haven't even talked about yields. I have talked about oil. I've talked about the MAHA trade. This is where I'm really kind of trying to figure it out, which is right here, right? So I know, for example, that, that China is right to be nervous, right? I get this. They have not needed to unleash fiscal stimulus, and they don't plan to until they can finalize negotiations with Trump. And Trump isn't even in the White House yet. But they have reason to be nervous because of this pending dollar devaluation to balance trade, de-dollarization, which is going to help the US debt problem. This will make the US dollar fall relative to CNH, and that will hurt China exporters. They have a reason to worry. So I don't think this is going to go away. I think Trump's going to negotiate it. He's going to have tariffs. They're going to devalue. But big picture, they know it's going to be harder. And so the end result is that the exporters to the US will be hurt. US exporters to the rest of the world will be helped. So think about those companies that actually derive a lot of revenue in dollars, right? I mean, that derive a lot of revenue abroad that convert into dollars. And those manufacturers are going to be also more incentivized to bring jobs back to the US, which is the hope and goal, which will drive wages and prices higher in the next few years. It won't happen right away. And those who are expert in this space of actually being CFOs at large companies have told me that in the first year, consumers they make sure the consumer doesn't feel it so much. In the second year, that's when they raise it. So this 2025 period may not be such a big hit. However, it depends who really is going to be in the seat of trade policy. Right now, it's suggested that this very, very strong China hawk, Robert Litzinger, I can't pronounce his last name either, he wants to be completely decoupled from China. I'm talking economically, technologically. So that's not going to be priced in yet. And then, of course, the Treasury Secretary will set monetary policy with the Fed, but will have to identify, again, with tariffs and with fiscal, how it's all going to come together to, how to do their refunding of the fiscal, how to work with the Fed, who right now is Powell. It says he's not going to leave until May of 2026. But the point is, there's going to be a lot of potential volatility moving forward with these policies, because there, at some point, both Chinese and US investors are going to realize this Trump train could derail the gravy train, which is triggering potential exodus or, repatriation of foreign money out of US stocks, bonds, and dollars, even if that's the goal. Okay, so even if that's the goal. So that's basically it in a big picture. It would be good for I think bonds as well. The other kind of Trump trade that I've talked about is that it could be very beneficial for peace. Now I know he's a big China hawk and Iran hawk. No, Iran war, whatever. But the point is, for the most part, we could get a situation where, and this is not at all popular and not political, but it is a fact that if we get into a situation where Trump says to Putin, right? And they keep talking, Even Putin today says he's not going to negotiate right now with anyone but Trump. If Trump gives him what he wants, which is pieces of Ukraine, right? Then there will be at least peace that should help Europe, that should help US bonds. It's not here yet. It's the opposite right now. They're escalating. And, Biden giving approval for long-range missiles and Russia retaliating. It's not a good scene right now, 59 days before inauguration. But when and if we could get this peace between Russia and Ukraine, we could actually have Trump remove the sanctions. Does anyone remember where the US shook the world and seized Russian assets? And they've used the interest off those assets to fund the Ukraine war. That's a big no-no for US Treasury value. So we could get that reversed, which would also help bonds. So if they remove the sanctions on Russia, that would be very beneficial for US Treasuries. That's basically it in a nutshell. So that's another kind of the peace trade that is the macro trade to tactically think about. If, however, they don't do these things that I've talked about, right? This is still my baseline bet, which is, right, this fiscal restructuring. And I know everyone really doesn't believe it, but I don't think you can dismiss Vivek and Musk too easily. But I do want you to kind of consider this. If they are able to do some fiscal restructuring, it's good for bonds, for US bonds. If Trump does come in with his peace trade, right, of removing sanctions on Russia and or returning seized assets, that's good for bonds. If they continue to stealth devalue the dollar to make up for high tariffs, that's good for US exporters who derive revenue abroad and convert back to dollars. And in time, I don't know if they're going to have enough time, it would be good for an industrial kind of renaissance, bring manufacturers and jobs back. It's a lot. All right, so now you're kind of thinking, okay, you've talked about the dollar, the Treasury Secretary and rates will matter a lot, by the way, because right now they have two that are pro rates, higher interest rates, and we have two that are lower interest rates. And none of the four are qualified to, in my opinion, really, really bring about an industrial renaissance. Three of them are, private equity, hedge fund guys. One's a senator, the other one is a former Fed head, but none of them have any experience actually in manufacturing and bringing jobs back. Nothing. So it's a little frustrating. Anyway, these are some of the other kind of overarching macro and then some micro trades. The cost of labor, yes, it can rise on the reversal of immigration policies, but like I just mentioned, if the government efficiency does its job of removing a whole bunch of chair warmers, then on the aggregate, we're going to have not a transition of government workers to do all the work that the immigrants are doing, right? The illegal immigrants are doing. No, it's different jobs. On the aggregate, it will spike unemployment higher. So it isn't, there is not a one for one here. You just can't get rid of 4 million illegal immigrants and also fire 4 million bureaucrats and then call it a day. They're not the same jobs. It will spike unemployment, and that's going to be a disinflation trigger that's going to bring rates down. That's, again, an if-then. So, and very, very likely they don't do it all at once, but then who knows, right? They're talking a big game. Energy, the cost of energy. I've shown to you that I think actually oil falls and I've been an oil bear since about April, May timeframe. Completely turned by the way. Became an oil bear in April, May, long before Trump came in and said, I want to reduce energy costs. I actually think that could help as a little bit of an economic stimulus, but it's going to confuse the macro folks that are used to having yields fall with oil and vice versa. That correlation, I think, is done. So unless we can get, this Department of Government Efficiency to really bring about some fiscal restructuring, then yields should also fall. Otherwise, forget about it. We're going to have a steady appetite of strong to higher yields, even if oil falls. Okay. And the cost of financing this huge deficit, if they don't spend, it of course falls, and the collateral value of bonds rises, but it especially rises from fiscal restructuring. So I can't underemphasize that fiscal restructuring is key. And that's why I'm so focused on the US Treasury Secretary. By the way, all four of the candidates, in my opinion, are not great. So I'm disappointed greatly about that, but I can't do anything about it. Really. So cost of devaluing the dollar, however, which is their goal, it means foreign demand of dollars will weaken, but it also means that we have at risk of some of these assets being sold, like I just showed you in Texas, which was, a few hours ago. But it also means US assets. It's at risk. So, how long will it take before US exporters can really benefit and rebuild the, industry? This is all that we're trying to figure out, and it's only been a week or two, and lots of moving parts and a cabinet that's not even full. Anyway, tax cuts, most are talking about this, but remember, they do serve as economic stimulus, mostly for corporations. But if they're, and again, I don't know if IRS is going to be eliminated. Wouldn't that be something? We, by the way, functioned as a nation for many, 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 many years with no IRS, with no significant taxes. It was tariffs. But at the most part, I'm not advocating that. I'm just saying we'll see if IRS gets shut down. But tax cuts do serve as an economic stimulus. But that means less government tax receipts. See how everything is like the yin and the yang? You got to balance all this. It's not just one and done. This is complex, man. This is like really very, 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 very hard to predict. So I want you to just kind of think about all of these different factors, because there are many players that he's trying to bring together to, I think, affect this as three overarching goals, right? But all of this other stuff we're trying to figure out along the way, and what could spike unemployment, what could spike yields moving higher, what could, what we're looking at is what's going to be a headwind for this lovely market rally that we have enjoyed, where the NASDAQ 100 is literally up as of today, 96% from January 2023 low, right? We're almost at 100%. Really. I mean, we had it's not even a bubble yet. So the point is, if we can get some continued economic stability, wage inflation, and productivity rise with inflation, we'll be fine. If inflation spikes up like it did in 20 and 21, and wage inflation couldn't keep up, we're not fine, right? So it's all about this balancing act. Right now, wage inflation with productivity is keeping up with the inflation. It's okay. We're in this kind of like Goldilocks period. Wage inflation has not spiraled higher. It also hasn't collapsed. So we don't have a recession risk front and center. But the point is, this stuff is always against the backdrop of the dollar. Its value relative to FX, which is foreign currency, relative to commodities. So right now, the dollar is still looking very much like the number one thing that they need to control. And through the dollar, yields will follow if they can get control of fiscal, which they say they want to. Then they'll have a much better shot at accomplishing this industrial renaissance. Otherwise, all bets are off. They will continue to do what they're doing right now, which is, repress rates, issue short duration T-bills versus longer duration notes and bonds, which keeps the whole gravy train working through stealth QE, monetary games, and financialization of assets where there's still tons of money running into things like MSTR and Bitcoin. But this will change if these three goals are really the goals and they stick that, agenda. Otherwise, we're going to be at this risk of they devalue the dollar too quickly, and that basically gets all the animal spirits getting very, very excited, and this everything bubble just grows larger without the fiscal restructuring, without bringing manufacturing and jobs home. So that's really why it matters. And I would not, honestly, you got a really tough bet right now because I think the market is obviously fine. I've written about this, right? Like this is not something I haven't thought about a tremendous amount and discussed with clients in our Slack workspace, etc. We got lots of reasons to stay, bullish. We have few signs, big picture, of a breakdown and selling under the surface. I do see interim selling and breadth breakdown that helps me position clients, short for a few days or a few weeks, but I'm talking big picture. Fed Treasury liquidity flows, it's basically an indicator that I use, is still there. It hasn't, fallen out. Option flow is still stupid bullish if you are into quantitative analysis. Oh my God. And NVIDIA makes the market. By the way, 60% of NASDAQ gains, this is no joke, of NASDAQ gains in 2024 are completely thanks to NVIDIA, right? So we have a situation where we continue to have breadth, which is underneath the surface. SPX 493 is doing much better than just the MAG 7. VIX is already below its 200-day. By the way, this was written back on November 9th, but it still applies, right? 10-year yield and the dollar are still in a Goldilocks zone, which for equities is below 107 for Dixie and 4.4% for the 10-year and above 3.8, which is also key. If it falls too low, we also have selling. Gold is in that Goldilocks zone. Jobless claims are also still under 267,000, which is key for me. And employment rate is below 4.5%. Trump has clearly won, and he's got a mandate. He promises tax cuts. He promises fewer regulations. He promises peace, right? We'll see. And fiscal restructuring with U.S. jobs coming home. Oh my God, no wonder the market was so excited when he came in, right? But there's a lot to do here. There's a lot to do. So I wanted to kind of just go over some of the Trump trade, both macro, breakdown still how the situation is still doing fairly well, but I have some concerns, and we'll kind of end that and take any last kind of questions. But the macro recession risks for 2025 do not go away. They were in place before my call that Trump would win, or the fact that he even did win, right? So my baseline bet is that even if they deliver on a lot of these programs that they've talked about, cutting war spending, oops, I got to put this in yellow, corporate welfare programs, really, if they get rid of a whole bunch of pork, it's still not going to remove the fact that they have an economy right now that is based on money printing. Lots and lots and lots of government money printing, QE, monetary policies that totally suppress price discovery and volatility. So this is the big thing. If we're going to have this smooth transition of planned devaluation of the dollar under Trump, right, which is bearish foreign holders of equities, which equates to 17% of just US equities, then you're going to have to kind of keep in mind that some of that money is going to go home. And the other big kind of warning is that this market is whacked. I mean, we have had parabolas after parabolas the past week that you see in MicroStrategy and Bitcoin and the rest, but this is kind of a behavior of a child that's overtired, about to crash, one last sugar-fueled manic move higher. So if we have a melt up in the market itself, and we've already played some of these really, really well. This NVIDIA, right? Gorgeous, up 8,000%. This Tesla, gorgeous. I mean, we play this. This is all very, very, very playable. But the point is, this becomes unstable. Parabolas equal trapped longs. Everyone becomes too overconfident. And then any trigger, macro trigger, can in fact create such volatility that it triggers liquidation. And you don't want that for our market. So the point is, we've got lots of things that they're promising, and we've got a backdrop right now that is conducive for continued rally. Just keep in mind the fact that this is what they're trying to do, is devalue the dollar for our prosperity. And we wish them, smooth smooth sailing, but I don't think it's going to be smooth. I think we're going to have some disappointment along the way. And I think at some point, inflation, which is equities, right? The way that we're manifesting inflation right now is through our assets. We all know this. There'll be a battle at some point between those who are front running tariffs, or the dollar devaluing, whatever. They're gonna try and kind of front run this policy interference that we've had by Fed and Treasury, these entrenched U.S. deficits, all this sticky inflation. It's all going to come together, and we're going to have a situation where the folks are going to kind of wake up and say, "Wait a minute, we actually have a government that's shrinking. That's their goal. We actually voted for this stuff, but the whole stock market is based on the inflation that is the government." So with that, thank you very much for listening. I basically am excited about macro, as you know, and I have a team that, of course, does everything from stock selection, sector rotation to macro. We have a service that is both for beginners, intermediate, and advanced. I'm obviously talking about some of the more advanced concepts, but I'm happy to talk about it because it is so timely. It's very, very, very important all as well. And I also, again, wish you a fabulous kind of vacation if you take it over Thanksgiving. It's definitely a very, very kind of volatile time for markets moving into the new year with a lot of uncertainty. Definitely consider, if you're interested not only in our services, which is lots of custom handholding for sure, but also if you're interested in learning options as a way to manage and mitigate some of this volatility, or take directional trades, or just sit back and collect income, definitely consider this free 3-part series. And I appreciate it, Anka and David, for the time to come talk about the Trump trade, macro to micro.
Subscribe to LaDuc Trading YouTube channel for more videos.